Welcome to the 3-Edge Week in Review for the week of June 24th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, Chief Investment Officer and CEO here at 3-Edge Asset Management. Today, Steve and I will be discussing a recent, rather ominous-sounding technical market signal that is referred to on Wall Street as the Hindenburg Omen. This actually was a signal that was developed all the way back in 1937. The signal was first triggered this year, a few weeks ago, by the NASDAQ index, and then more recently, the S&P 500 index also tripped the Hindenburg Omen technical market signal. Before we get to today's topic, a quick look at the global capital markets this past week, and the biggest economic news came on Friday when the Bureau of Economic Analysis released the Personal Consumption Expenditures Price Index, otherwise known as the PCE, for May. This report is important since the PCE deflator is the Fed's favored measure for monitoring inflation, and the report came in quite close to the consensus estimates on Wall Street, and it showed that in May, prices increased at their slowest pace since March of 2021. And in addition, the core PCE, which excludes food and energy, also came in line with estimate, and May's reading for core PCE marked the slowest annual increase in core inflation in over 3 years. So in the end, the report is good news on the inflation report, but inflation does remain above the Fed's 2% target as the Fed considers when to begin to lower short-term interest rates. So now let me bring Steve into our conversation and let's talk about this Hindenburg Omen, it's a mouthful, which based on the fate of the Hindenburg, which crashed in Lakehurst, New Jersey in 1937, doesn't sound encouraging. So Steve, why don't you begin by describing this rather scary-sounding technical market indicator known as the Hindenburg Omen and how it is actually triggered?
Well, it was developed by a mathematician named James Mika, and it's designed to predict significant market downturns, at least within a few months of when the signal gets triggered. And as you said, it recently got triggered both in the NASDAQ and the S&P index. That's why it's in the news. It actually got triggered in 1987 before the crash of 87, in 1999 before the tech stock bubble burst in 2000. In 2007, it was triggered before the financial crisis of 2008. And it was triggered again in 2000 and 2021 before the downturns that followed. So it has done a pretty amazing job triggering right before some significant downturns, but caution because it has also triggered and then not been followed by significant downturns. So it's not all that reliable. There's a small sample size, so you can't consider it scientific. And you can say that it works best when corroborated with other market signals.
So, now that we know what the Hindenburg Omen is and how it's triggered, why don't we dive a bit deeper into what it might be telling us about the current state of the markets here in the summer of 2024?
Well, there's several rules involved in the construction of the Hindenburg Omen, but the main idea is that there's an observation that when markets are in a bubble, peak and then have a significant downturn, one of the key characteristics is that as they rise to the top, they get more and more narrow, meaning that fewer and fewer stocks are responsible for the majority of the gains. And that's why it got triggered recently, because in both the NASDAQ and the S&P, over half of the stocks in those indices are actually making new 52-week all-time lows at the same time when the indices keep going up and making new records. So let's look at some other indicators that may or may not corroborate the Hindenburg. One is that there are sentiment indicators that indicate how bullish or how bearish investors happen to be. And at tops, you find extreme bullishness and very, very little bearishness, and at bottoms, the reverse. And the recent sentiment indicators are that we are very close to historic extreme bullishness and very, very low extreme bearishness. So that corroborates. Second, we have meme stocks, which are stocks that go way up in price, divorced of their fundamental values. and the so-called Roaring Kitty, who was present during the last big rally in 2021 and appeared again, another sign of market mania. Next, we have that 10% of the stocks in the S&P index comprise over 75% of the market value of the entire index, which is very narrow, very extreme. This only happened 2 times in history. One was in 1929, and the other was in 2000. And following both those signals, we had an over 80% decline in the U.S. stock market from 1929 to 1932, and we had an over 80% decline in tech stocks from 2000 to 2002. Next, we have extreme market valuations as measured by price-to-sales ratios. There were only 2 times in history when they were near this high, and you guessed it, 1929 and 2000. So we've got a lot of corroborating signals that we're close to a market top, that we're at risk of a significant market downturn sometime in the next several months. But here's the catch. You could go back in time and find similar signals well before the market actually peaked. And so one must be careful that this rally could continue for an extended period before we would see a downturn.
My final question is, how should investors be thinking about the current state of the U.S. equity markets, and what might investors consider doing in response to this triggering of the Hindenburg Omen by both the NASDAQ and the S&P 500?
Well, these are not normal times, and you don't see these signals pop up very often. So I think investors should take it seriously. On the other hand, there should be a balance, because while these signals are present and while our own models are indicating danger that the next correction could be quite severe because of the overvaluation, it is also true that this could continue to extend quite a bit. And we all know stories where people who were overly defensive too early had a lot of regret, had the fear of missing out, and then jumped back into the market right at the peak. So we think it's much more appropriate to have a balance between the likelihood of a significant downturn at some point, but also the continued rally for some time. So we can turn to our model. It's a dynamic model of the global capital markets that takes in many valuation factors, many macroeconomic factors, and importantly, investor behavioral factors to help us decide what are the likely causes and effects that are going to make the market either continue to rally or start to correct. And if I would summarize what the factors are saying now, it would say that yes, and over the long term, the U.S. stock market is highly overvalued. And it's not because the quality of the companies. The quality of the companies in the U.S. index are tremendously high. But it's that investors have gone ahead of themselves and placed a price per share well in advance of what would be suggested by the growth in sales or the growth in profits. Maybe as much as 5 to 10 years ahead of the natural course of events based on fundamentals. Intermediate term factors are mixed. So there are some indications that an economic slowdown is quite probable with a lag, but there are also economic indicators like credit spreads that say that a slowdown isn't quite imminent yet. So they're mixed. And then the short-term factors are still, in our model, still positive, meaning that there's still room for a continued rally. So I think the answer is that the short-term factors are pointing to the possibility that this rally could continue. These short-term factors could change overnight, and history shows that sometimes the catalyst that causes them to change is quite random. It's a black swan. It's an unpredictable event that comes out of left field, perhaps. And that's why it's so hard to predict. So one should be careful that would be tempted to be 100% invested in the market, because at any time overnight that something bad could really happen. It'd be hard to react. On the other hand, someone who's overly defensive could really miss out on a few more months of an extended rally. So I think overall, one should consider their own relationship between how fearful are they of losing money versus how fearful are they of missing out. And we have 3 core strategies that can address different parts of that spectrum. For those that are much more concerned about losing money, I think our conservative strategy is an excellent safe haven where we really focus on managing downside risk, but still have the potential of targeting a rate of return that's quite a bit above inflation in a modest but steady way. And then we have, on the other side, a growth portfolio that's quite invested in equities at this time, but that when the model tells us it's time to get more defensive, we have that ability. And then in the middle, we have the total return strategy, which is a balance of both of those. And what's so important is how you diversify your risk. You own equities. Depending on the strategy, you own more equities in growth than total return and in total return than conservative. But how do you hedge that equity risk? Well, traditional investment management, traditional finance typically says you hedge it with bonds. But as our model has shown, as observation of market cycles have shown, bonds are not always the best hedge. And in this particular environment, they certainly might not be. So, for example, if what causes an equity market downturn is a geopolitical conflict, then gold or commodities would be best hedges. And the same forces that cause the equity market to go down are the same forces that would cause gold commodities to appreciate. And be glad to have that as your hedge. If it turns out it's stagflation that's causing the market to take a hit, well, TIPS, or Treasury Inflation Protected Securities, are the perfect hedge that will do well in a stagflationary environment, because in a stagflation, you have both the economy coming down and inflation continuing to go up, so you're protected. If it's because of a credit contraction, then low duration treasuries are your best hedge. If it's because of a deflationary recession, then intermediate or longer term treasury bonds might be your best hedge. And then finally, if we have excessive stimulus because the government and the Fed are worried about a slowdown, then gold is your best hedge again. So the benefit of the model is it's looking at all these factors in a dynamic way, and it can change the asset allocation and mix across the strategies to make sure that we have the best hedges in place on behalf of our clients.
All right, Steve, thank you. Thank you for insight into this market signal known as the Hindenburg Omen. And I suppose like every aspect of investing in the stock market, there isn't that much certainty out there, and there certainly are no guarantees. So that will do it for Steve and me for this week's edition of the 3Edge Weekend Review. As a reminder, all our videos are always available on our 3Edge YouTube channel. And if you think you know someone who might benefit or enjoy our weekly videos, please feel free to share them. As a programming note, next week marks the 4th of July holiday, and so we will not be recording our regular Weekend Review video next week. Eric Beagleisen and I will be back in 2 weeks with our monthly 3Edge View from the Edge newsletter. So, until then, on behalf of Steve and everyone here at 3Edge, we wish everyone a wonderful 4th of July holiday in the coming days with family and friends. And, as always, we thank you for listening.